Hey, what's up guys? Casey Dimon here, TaxSellAcademy.com. Thank you so much for joining me on today's live stream right here on YouTube. Today, we're gonna go back to the basics again. If you remember right, a few days ago, we started discussing tax liens and just how valuable they can be as an investment tool. Today, we'll be discussing tax deeds. Tax deeds and tax liens are very similar, yet they're very different. So let's go ahead and discuss tax deeds, all right? So what exactly is a tax deed and why is it such a great investment vehicle? First off, you need to understand that a lot of people use the term and the phrase buying tax deeds. I'm going to buy tax deeds. A tax deed is technically just a special type of deed. It's the instrument that transfers property from one person to the next person. There are a few different kinds of deeds, but what makes a tax deed special is that they're only used to transfer tax defaulted real estate. So a tax deed is just an instrument. It's an actual instrument, but a tax deeded property or a tax foreclosed property is a type of property that we're about to discuss. As with every tax foreclosure and every tax sale process, the property will have had to have reached the stage where it becomes delinquent prior to anything starting. The owner of that property must be late paying their tax bill in order to initiate the tax foreclosure process. Now, when it comes to a tax deed state, instead of a lien being sold like you have in tax lien states, that lien is essentially kind of held in-house for a set period of time. And some states, actually a lot of states, they don't even call it a tax lien, just to avoid confusion. They just call it a delinquent tax bill. So they hold this tax bill in-house by the county. Now, during this delinquency period, the county will still charge the owner of the property, the delinquent property owner. They're going to charge them interest and fees and penalties and all sorts of other stuff. Now, in the event that the property owner is able to pay off the back due interest, penalties, fees, and all that good stuff, then the county will release that county-held lien, or they'll remove that property from the delinquent tax list. Now, if the delinquent taxpayer, if the delinquent owner of that property is not able to pay off everything that is due within that redemption period, the county will start the process towards tax foreclosure. And this is an act that will require the county to follow certain steps as dictated by their state statute. So they'll have to go through all these steps, and ultimately, that property will be sold at a tax sale auction. Now, we're going to touch on auctions momentarily, but it's important to know that depending on the specific state, the tax foreclosure process can really vary substantially. In some states, they'll actually foreclose on the property and then they will take title of the property in the county's name. Then they'll sell the property as the owner. And what this allows them to do is a lot of stuff. They can set minimum bids, they can bundle properties, they can set bond requirements, they can do all sorts of stuff if they handle it that way. In other states, the state statute says that the property actually doesn't transfer to the county, but instead that property will transfer from the owner to the new buyer, to the tax deed buyer at the auction itself. And I see a couple of questions pop up. I'll answer those at the very end here. So how does a tax sale auction work, right? We talked about tax liens. We had like bid down method, premium, all that good stuff. When it comes to a tax deed auction, it's pretty simple. The person that's willing to spend the most amount of money to buy that piece of property walks away with that property. It doesn't get a whole lot more simple than that, guys. Now, depending on the state, there'll be two different types of tax deed sales. You're gonna have a standard tax deed sale and a redeemable tax deed sale. A standard tax deed sale is where they sell the property, and when you walk out of the auction as the buyer, or once they record that deed, depending on how exactly it works, but once the property is transferred into your name, the delinquent taxpayer no longer has a claim to that property. Now, there are a few very, very, very rare exceptions in a couple of specific states, but that's how it is, guys. Once you buy that property, the delinquent taxpayer can't just come in and say, hey, I want that property back, here's my money. It does not work like that. Now, on the flip side, you have a redeemable deed state, which kind of does work like that. What happens in a redeemable deed state is the property is sold just like a standard tax deed state. They actually sell the property and they'll even transfer that property into your name. But when it comes to redeemable deeds, there's one final window or one final redemption period in which that delinquent owner can still come in and make the payment of the interest, fees, taxes. And when they do that, it'll actually cancel or void that redeemable deed. So you buy the property, you buy that redeemable tax deed property, and you actually become the owner of it, subject to the former owner's right of redemption. Now, this redemption period can go anywhere from 60 days up to 2 years. Now, if the deed is redeemed during this redemption period, you're not completely out of luck. They don't just say, hey, better luck next time, right? If it does get redeemed, you'll actually get your investment back plus anywhere from 12 to 25% as a penalty that is charged to the owner. So a nice little kicker there. In the best case scenario, of course, the former owner does not come in and they don't redeem that property, then you own that property outright without the possibility of them ever having any future claims. Worst case scenario for a tax deed is basically where you buy the property, they come in and redeem it, and you get 12 to 25% on your money. You're not going to find that type of return in most places, especially as safe as real estate, as long as you did the proper research prior to your purchase. And then, of course, when it comes to redeemable tax deeds, there's all sorts of other benefits depending on the specific state. For example, you can collect rent in some states. So as you can see, tax deeds, they can be a very, very incredible investment vehicle. Of course, some states don't offer tax deeds. They do a tax lien system. And guys, I mentioned a few days ago and actually have a link down below this video. If you want to know whether it's a tax lien state or tax deed state, want to get all the details, head on over to taxsaleacademy.com/state-guide. That's taxsaleacademy.com/state-guide. It has a color-coded map on there for you. Kind of clue you in on how the different tax sale processes work in the different states. Ben asked a question, do I personally invest in tax liens? Yes, I do, Ben. Early in my career, I actually hated tax liens because I hated the thought of receiving 10 to 20%. I thought that was just ludicrous when I could get 100 or 200%. But as I got wiser and as I got a little bit older, I realized, hey, these are very, very strong investment vehicles. And a lot of states you can do very, very well. There's some states that are ultra competitive. So if you pick the right state, pick the right area in that state, you can do very well with tax liens. Thanks for your question, Ben. Guys, I really hope you've enjoyed today's live stream. As always, if you enjoy these live streams, go ahead and just click that thumbs up button just to let us know. That way we'll continue producing them for us. And of course, if you're looking to learn more about investing in tax defaulted real estate, head on over to taxsaleacademy.com. That's taxsaleacademy.com. That's it for today, guys. Made a successful day. Take care. Bye-bye.